And gentlemen, good day and welcome to Q1FY23 earnings conference call of Delhivery Limited hosted by Morgan Stanley India Company Private Limited. Before we start, we would like to point out that some of the statements made in today's call may be forward-looking in nature, and a disclaimer to this effect has been included in the earnings presentation shared with you earlier. Kindly note that this call is meant for investors and analysts only. If there are any representatives from the media, they are requested to drop off this call immediately. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Gaurav Rateria from Morgan Stanley. Thank you, and over to you, sir.
Thank you, Nirav. Hello, everyone. This is Gaurav Rateria from Morgan Stanley. Thank you all for joining us for Delhivery's earnings call to discuss fiscal 23 first quarter results. To discuss the results, I'm pleased to welcome Mr. Sahil Barua, the CEO and MD, Mr. Sandeep Barasia, Chief Business Officer, Mr. Amit Agarwal, CFO, and Mr. Varun Bakshi, the Head of Investor Relations. I thank management team for providing us this opportunity to host this call. I now invite Mr. Sahil Barua to take us through key financial highlights for the quarter, post which we will open the floor for Q&A. With that, over to you, Sahil.
Thank you, Gaurav, and thank you all for joining. A very good evening to you and welcome to our second earnings call. Just a quick check before I go ahead that I'm completely audible.
Yes, sir, you're audible.
Thank you. So the agenda for this call is to walk through our earnings presentation in about 20 minutes, and then we will open up for questions. Apart, if you can move to the next slide. For those of you who are joining for the first time, a brief background on Delhivery. The objective behind Delhivery is to build the operating system for commerce in India, which means we essentially provide the infrastructure, the services, and the technology that allow buyers and sellers to transact with each other in the real world. These buyers and sellers may be businesses transacting with businesses, businesses transacting with consumers, or consumers transacting with consumers, both within the borders of India or from India to abroad or abroad to India. Moving to the next slide, Apar. A quick snapshot of our performance in quarter one fiscal 23. We continue to be India's largest integrated logistics platform. In quarter one of financial 23, we registered 1,746 crores of revenue from services, which represents a 30% growth over our revenues for the same quarter in the previous financial year. Quarter one financial 23 adjusted Ebitda margins stand at negative 12.5%. We delivered 152 million parcels in our express business in quarter one financial 23 and have delivered close to about 1.6 billion packages since our inception in 2011. In quarter one financial 23, in our part truckload freight business, we delivered close to 240,000 tons of freight and have shipped close to 2.5 million tons of freight since financial 19. We run one of the largest networks in the country and operate close to about 18.9 million square feet of logistics infrastructure across the country. This includes automated sortation centers, trucking terminals, air terminals, and fulfillment centers across India. We have over 29,000 active customers who work with us across multiple business lines, which include express parcel shipping, part truckload shipping, full truckload shipping, supply chain services and warehousing, and cross-border logistics. 54% of our revenue comes from customers who use 2 or more of our services, and we cover 18,435 PIN codes across the length and breadth of the country, as defined by the Indian Post. A quick snapshot of our key operating metrics for quarter one fiscal 23, which is the column on the extreme right. Between the end of financial 22, since our last earnings call, and the end of quarter one financial 23, we've expanded our PIN code reach from 18,074 PIN codes to 18,435 PIN codes. Our overall customer base has expanded from 23,600 customers to over 29,000 customers as of the end of quarter one financial 23. As discussed earlier, we've expanded our overall logistics infrastructure from 18.15 million square feet to 18.9 million square feet as of the end of Q1 financial 23. We continue to have the largest number of gateways, automated sort centers and processing centers among logistics companies in India. We operate 96 gateways across the country, 21 automated sortation centers, 189 processing centers, nearly 3,000 express delivery centers, about 240 freight service centers. And we have an overall team size of close to about 60,000 people across the country. Moving to the next slide. Key milestones for Q1 financial 23. The first is one that we had referred to in our communication with shareholders earlier in this quarter, which is the completion of the operational integration of SpotOn. To refresh everyone's memories, SpotOn was a part truckload freight business that we acquired earlier in financial 22. The integration was planned in 3 phases, which I will talk about in more detail through the call, which began in Q3 of the last financial year. And the final phase of the integration was scheduled for Q1 of this year. We've expanded total infrastructure to nearly 18.9 million square feet and commissioned and taken live our automated mega facility at Taudu, Bilaspur in Haryana, which is now fully operational. We also launched a guaranteed same-day delivery service aimed at direct-to-consumer e-commerce customers across the country. We've also launched our consumer-to-consumer shipping application, the Delhivery app, for consumers to book and track consignments in real time. Our client roster has grown in Q1 as well. We've onboarded over 500 new customers in our express parcel business, and our supply chain services business continues to see robust demand for our integrated services. We've onboarded 2 of the world's largest auto manufacturers, a major multi-brand retailer, a global electronics major, and one of India's largest paint companies in our supply chain services business. And on the technology front, we've been awarded 2 US patents for our data sciences work for AdFix and UAID, which are our proprietary systems. Just a quick snapshot of Q1. I'll begin with a quick update on the SpotOn integration. The integration of Delhivery and SpotOn, as I pointed out, was carried out in 3 phases. It required us to assimilate over 2,000 members of the SpotOn team, about 5,500 customers who were serviced by SpotOn prior to the integration, an infrastructure of about 2.5 million square feet, which was spread across 350 operating facilities. And all of this was to be brought into the combined Delhivery and SpotOn network. As part of phase 1, which was in Q3 of the last financial year and completed successfully in December 2021, our first aim was to integrate clients and teams, restructuring customer contracts for all of the 5,500 SpotOn customers, ensuring parity with Delhivery, and integrating the SpotOn team of over 2,000 people into our organization. As part of phase 2, which was completed during Q4 of the last financial year in March 2022, we completed integration of client-facing and operations systems, which was a full integration of our technology systems, essentially setting us up for moving all operations to a single integrated network in phase 3. Phase 3 was begun in Q1, which was the final integration of operations, which included both the infrastructure and the network operations of both companies. The decision to complete the integration in Q1 was based on certain factors in our business. First of all, on business cyclicality, where Q1 volumes in a financial year are typically lower than Q2 to Q4. The second was in line with our annual capex cycle. Delhivery typically commissions new infrastructure, which goes live in Q2 and Q3 of the financial year. And so integrating prior to the commissioning of new infrastructure would allow us to bed in this infrastructure with the combined volumes. The third factor was avoiding monsoon and making sure that we were essentially not disrupted by the rains across different parts of the country. And the fourth was the avoidance of the e-commerce peak season, which typically hits us in Q3 of the financial year. In Q1, while we started the operational integration, the overall process of integrating the infrastructure and the network took longer than we originally expected. This was down to a couple of reasons. First was higher than forecasted volumes, which created bottlenecks at some of our key facilities at the automated gateways in both Taudu and Bhiwandi, but also at some of the facilities where both Delhivery and SpotOn had not established sufficient infrastructure to service incremental customer demand, which included locations like Chennai and Pune. As a consequence, we made the choice to pause volumes from a selection of key accounts and some accounts who had either specific business processes or specific requirements for freight handling, until operational parameters were conclusively stabilized. Operational service levels have returned to pre-integration levels. They returned to pre-integration levels within a few weeks of beginning the integration and have remained stable since. Moving to the next slide, the impact of the integration, which I will talk about in more detail as we go through the financials, first of all, has arisen from service stability. Service stabilization took us 4 weeks longer than originally expected at the start of the quarter, largely due to the automated gateways at Gurgaon and Bhiwandi having a temporary effect on service precision. There were higher than normal service error-related claims from customers that had to be settled during Q1, which have caused higher revenue provisions during the quarter, and a temporary period of disruption for our pickup and delivery business partners due to a change in their serviceability as they moved from the spot-on network to the combined delivery and spot-on network. The proactive reduction in volumes, along with the reduction from select clients, also affected us overall in Q1 financial 23. And we made the decision to maintain capacity across our 3 key resources, which are staffing, fleet, and infrastructure, to ensure service stability through the period. And as a consequence, we see slightly higher unit costs, which are elevated during Q1 financial 23 compared to Q4 of financial 22. In addition, there are one-time transition costs of the integration, which we expect will normalize over financial 23. For instance, due to commercial or contractual reasons, we have had to run a certain amount of redundant infrastructure and certain software licenses, and there are certain administrative costs from the spot-on entity that have continued in Q1. We also paid a one-time compensation to key business partners and channel partners in Q1 to support them through our integration period. Outside of which, there have been substantial technology and development costs both in Q4 financial 22 and Q1 financial 23 as we've integrated delivery and spot-on systems. The overall impact is what you see in the slides to follow. As you can see on the left-hand side, overall revenue between Q1 financial 22 and Q1 financial 23 has grown by about 30% year-on-year, from 1,344 crores to about 1,746 crores. The composition of the business has changed slightly owing to the integration effect of the PTL business. PTL, which was 23% of the business in Q1 financial 22, is 15% of the business in Q1 financial 23. Express parcel revenues have grown by 34%, from 785 crores in Q1 financial 22 to 1,051 crores as of Q1 financial 23. This is despite seasonality in the express business, where Q1 of a financial year is typically depressed, and the exit of Shopee from the Indian market in Q4 of financial 22. Express parcel shipments grew strongly through this period. We have seen 50% growth year-on-year, with Q1 financial 22 volumes of 102 million growing to 152 million for Q1 of financial 23. Part truckload freight revenues have degrown by 16% between Q1 financial 22 and Q1 financial 23, owing to the reasons I spoke about earlier, where we proactively shut down some client volumes for a period of time, and some clients chose to proactively cut volumes as well through this period. Overall freight tonnage degrew from 279,000 tons of freight to about 234,000 tons of freight in Q1 of financial 23. Moving to the next slide. Our other business lines, which are the truckload business, the supply chain services business, and the cross-border services business, continued to show robust growth in line with our original plan. The FTL business has grown from 55 crores of revenue in Q1 financial 22 to over double that in Q1 financial 23, registering nearly 122 crores of freight value transacted. In the supply chain services business as well, we've seen about 120% growth year-on-year, with Q1 financial 22 having 106 crores of revenue, which has grown to nearly 240 crores of revenue for Q1 financial 23. And revenue from cross-border services, excluding traded goods, has grown from 51 crores of revenue in Q1 financial 22 to 78 crores in Q1 financial 23, as our integration with FedEx has stabilized. In terms of adjusted Ebitda, Q1 financial 23, which is the third column in the table, revenue from customers, as discussed, stands at 1,746 crores. We are broadly neutral at the service Ebitda level, with a final adjusted Ebitda of negative 217 crores or minus 12.5%. Compared to Q1 of financial 22, where we had an adjusted EBITDA margin of -4%. So a decline in the adjusted EBITDA by about -8.5%. And compared to Q4, where we made an adjusted EBITDA of 81 crores, a change of about 300 crores. Moving to the next slide. This is a quick bridge on the change in adjusted EBITDA from Q4 financial 22 to Q1 financial 23. At the top of the table is the Q4 financial 22 adjusted EBITDA of 81 crores. In Q1 of the year, we typically add, as I discussed, manpower, fleet, and infrastructure capacity in anticipation of higher volumes between Q2 and Q4. We added close to 21 crores of costs in this period, which is 2,500 additional staff, 30 trucks and 85 trailers, which is in line with our sort of larger objective of movement to trailers, and about 740,000 square feet of transportation infrastructure. As I discussed, we chose to continue and retain existing capacity of fleet, of manpower, and of infrastructure in anticipation of service recovery to ensure that service levels stayed stable and to make sure that as volumes went up, client experience was not affected. The overall cost of the underutilization of this existing capacity is to the extent of 150 crores in Q1 of financial 23. And in addition, our annual inflation cycle, which comes from wage hikes and rent escalations, has added up to 17 crores. So the net impact of B1, B2, and B3 is 188 crores. In addition, the exit of Shopee, which gave us 22 million parcels in Q4 financial 22, has an impact along with reduced revenues in the part truckload business of close to about 60 crores, leading to a total reduction in service EBITDA of 188 per 60, which is 248 crores, and a minor increase in corporate costs, leading to a total impact of 252 crores. Excluding one-time integration costs, which include one-time provisions for heightened claims from customers and 6 crore in payments to vendors as support for Q1, the adjusted EBITDA prior to the integration cost stands at negative 171 crores, and including one-time integration costs, which we do not expect will continue into Q2 and beyond, at negative 217 crores. The next slide shows a comparison versus prior periods. In steady state in Q3 financial 22 and Q4 financial 22, the business had achieved adjusted EBITDA margins of close to 4%, which in Q1 financial 23, affected by the spot-on integration, stand at negative 12.5%. The next slide is a detailed breakup of the adjusted EBITDA. Total revenue from customers for Q1 financial 23 was 1,746 crores. Total expenses stood at 2,206 crores. After adjusting for non-cash expenses and adjusting for lease adjustments due to AS 116 and one-time operating expenses such as our IPO expenses and a non-cash, non-operating cost, the adjusted EBITDA stands at negative 217 crores as discussed, as compared to 81 crores for Q4 of financial 22 and negative 58 crores for Q1 of financial 22. The adjusted cash PAT for the same period stands at negative 187 crores or negative 10%, compared to 5% in Q3 financial 22 and 6.6% in Q4 financial 22. The adjusted cash PAT bridge is the same as the adjusted EBITDA bridge with more or less the same adjustments. Finally, in our previous earnings call, there were a number of initiatives that we had outlined for financial 23. This is a quick update on where we stand on each of those. The first was the integration of the delivery and the spot-on networks. So all three phases of the integration between delivery and spot-on have now been completed. Customers and teams have been integrated. Technology systems have been integrated, and operationally, from an infrastructure and network operations standpoint, both networks stand fully integrated. And as discussed, service levels have stabilized as of the end of Q1 financial 23 and remain robust. We continue to integrate the networks and grow volume, and so we continue to realize network synergies, and we'll launch our economy PTL service through financial 23. We are in the process of expanding our overall infrastructure by about 4 million square feet. About 740,000 square feet has been commissioned and delivered. We continue to expand our tractor-trailer fleet to its full size of 150 TTs and have expanded our automated sortation capacity by 35% in this period in advance of peak season volumes. We continue to introduce new automation across our major sort centers and our hubs, have moved fully to system-directed mid-mile operations as expected with the integration of delivery and spot on. We continue to expand usage of electric vehicles across our entire network and continue to pilot LNG and EVs in our mid-mile operations. Our cross-border express product now stands fully integrated with Delivery and FedEx now code-sharing airway bills seamlessly. Our supply chain services business, as discussed, continues to show robust growth. We've grown by nearly 120% between Q1 of last year and Q1 of this year, with a focus on key industry verticals like auto, chemicals, consumer durables, and retail. We have launched the Delivery Direct-to-Consumer Academy and are in the process of launching our unified client portal and our merchant panel for small and medium businesses to access all of our products. We've launched the Delivery Direct Consumer-to-Consumer shipping app and are in the process of launching our Orion truckload price discovery and booking application, and are in the process of launching our platform service for global third-party developers, along with our SaaS offering in select international markets. So that's a brief summary of financial performance through Q1 of fiscal 23. With that, I will pause, and we are happy to take questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and one to ask a question. The first question is from the line of Abhishek Pathak from HSBC. Please go ahead.
Hi, thank you for the opportunity. I had a couple of questions. The first one was, we are seeing some sequential pressure in global e-commerce volumes. Do you see something similar or at least a deceleration happening in the Indian e-com space, over the short term and the next 2 to 3 years? That's the first one. And number two, there have been some questions around the viability of the social commerce model. And considering we have, significant dependence on social commerce platforms for volumes, is this something that the company sort of worries about over the short to medium term? Thank you.
Thanks, Abhishek. Good questions. Let me begin with the first one, which is, are we seeing a slowdown in e-commerce generally in India? The short answer to that is not yet. If you look at our volumes, they have grown 50% a year between Q1 of last year and Q1 of this year, from 100 million shipments to 150 million shipments. Even adjusting for share gain that we have had in this period, I think that does represent growth in the market overall. If you remember in our previous earnings calls, one of the things that we had pointed out is that while individual players were likely to see turbulence in e-commerce through this financial year, we are pretty confident that the broad trend for e-commerce continues to be positive. And when you look at the underlying reason, it's simply the fact that e-commerce in India is heavily underpenetrated. Penetration in India is less than 7%, whereas comparable penetration, for example, in a place like China would be north of 20%. And so we expect that there will continue to be a secular shift towards e-commerce going forward. Individual players may certainly continue to face turbulence. And from a delivery standpoint, as we discussed, we don't have a significant dependence on any single client. And so in that sense, there is no impact on our overall volumes, as you can see. Outside of that, I think the second question was around social commerce. I think the way we look at it is that a variety of players will experiment with different models in e-commerce. However, the broad trend towards buying online will continue. Even players who, sort of have been bracketed under social commerce have sort of pivoted to being a mix of social commerce and more traditional big box commerce. And I think irrespective of the model that different players will follow, the demand from consumers will continue. And given that we're the largest player and the most efficient player in the country, our volumes will continue to remain stable. So we don't see a large risk going forward.
Abhishek, line is on.
Thank you. Thank you for that. Thanks.
Thank you. The next question is from the line of Hitesh from CLSA India. Please go ahead.
Yeah, thanks for taking my question. My first question is on you alluded to the fact that you've gained some market share in the e-commerce space. Can you talk about how much the industry has grown during this quarter? And my second question is on profitability, right? I mean, I understand this is a weak quarter because of integration issues and also lower volumes. But how should we look at profitability over next 2 quarters, right, when the integration benefit starts coming and volumes scale up? So if you can give us some guidance on how margins could scale up from here on.
Yeah, sure. Let me begin with market share in e-commerce. I think, again, I'll direct you first to the overall growth in volumes from Q1 of last year to Q1 of this year, which is from 100 million shipments that we did last year to 150 million shipments this year. So I think we certainly have gained market share in this period because the industry has not grown by 50% in a year. Between Q4 of last year and Q1 of this year, it's a little difficult to say because of the outsized impact that Shopee's exit had on the market overall. I think when you include Shopee, it's safe to say that the market has not grown between Q4 financial 22 and Q1 financial 23. Whereas when you look at our volumes, adjusted for Shopee, we've remained broadly at the same 152 million mark. So when you adjust for that, I think we've gained some share in the market between Q4 and Q1. To your second question, in terms of profitability, I think while we're still in the process of regaining volumes and our service levels have remained stable, we have seen recovery of volumes from all of our major customers. The overall recovery will play out through Q2 as well. And so we remain optimistic about it. But the way to think about our business is pretty simple. As I mentioned, in the slide that we presented earlier, Amit, if you can just bring up that slide briefly, Amit or Apar. The bridge from 81 crore of Q4. Yeah. If you look at this, the biggest impact really on profitability has been point B2, which is underutilization of existing capacity, which is 150 crores, and the revenue-led reduction in service Ebitda, which is the 60 crores. So first of all, and obviously the 46 crores of one-time integration costs. So first off, obviously we do not expect the one-time integration costs to persist through the year. The second is as volumes come back, the underutilization of existing capacity should disappear and the network should automatically become more efficient. One thing that I should point out is that this existing capacity itself will shrink a little bit going forward because we do continue to carry infrastructure, we do continue to carry certain contracts from Spoton's sort of previous days, which we haven't yet fully deprecated. If you can go to the KPI slide for a second, Apar, at the start of the deck. One of the things that you will see here is that the number of gateways have declined from 123 as of the end of financial 22 to 96 as of Q1 financial 23. And similarly, the number of freight service centers have declined from 267 as of the end of financial 22 to 237 as of Q1 financial 23. And so as these contracts become available for renewal or for termination, we will continue to sort of consolidate the combined delivery and Spoton network and continue to sort of realize synergy going forward. So that's sort of how the excess capacity will get absorbed.
Okay. Sorry, if I can ask one more question, just a final question.
No.
On pricing front, we are seeing some stability on the e-commerce pricing, where it is kind of not gone down much, right? So should we expect the pricing to remain now stable, or you will still, because you're the lowest price in the industry, or you will continue to prioritize market share over pricing in e-commerce segment?
Pricing is a strategic decision that we take at an account level. The difference in pricing that exists between any 2 quarters could also be because of a change of mix, for instance, or a change of the distance that parcels travel. In this case, there's obviously a big difference because of the disappearance of Shopee between Q4 and Q1. We evaluate pricing at every customer level, and depending on sort of the customer's ambitions for growth going forward and what our margin projections for each individual customer are. But suffice to say, I don't think we will be taking any significant pricing actions through the rest of the year.
Great. Thank you. All the best.
Thank you.
Thank you. Next question is from Mukesh Saraf from Spark Capital from webcast. Slide 12, inflation impact of 17 CR. Could you let us know which segment this impact has primarily been felt in, as there would usually be passed through a fuel hikes to customers? Would these costs be subsequently passed through with a lag? Supply chain revenue has grown to 236 CR in the quarter. What is the total warehouse space square feet for this segment as of June end? What is the target for space addition in FY23, FY24? Is there a split between transportation and warehousing for this 236 CR, or is this entirely warehousing?
Sure. Let me start with the question on inflation. The overall inflation of 17 crores includes inflation due to wage hikes, inflation due to renegotiation of rental contracts, and inflation due to fuel. In the part truckload business, you're right. The hike in fuel is essentially passed through to customers entirely, and so to that effect, it doesn't have any impact on profitability directly. So majority of this comes from wage hikes and rent escalation. Given that we run an integrated network, it affects all of our businesses sort of in a conjoint fashion, because our part truckload business and our express business share the same people, they share the same fleet, and they share the same infrastructure. In terms of supply chain, I'm sorry, there was a question on would these costs be passed through with a lag. We discussed this earlier. Fuel inflation is typically passed through with a max lag of 15 days to customers, which is in line with sort of regular industry norms. Your question on supply chain, the revenue of 236 crores is a combination of transportation and warehousing revenues. The target for space addition in fiscal 23 is likely to be close to about 1.67 million square feet. However, I should point out that this is a projection at this point in time based on the pipeline that we have and the contracts that we've agreed. And sort of as we get closer to real-time commissioning of these and availability of space, this number may change a little bit. But I'd invite Amit, who is our CFO, to comment on question 2 as well. Amit, if you are on the line.
Yes, hi, thank you. So our supply chain services business did 236 crore of revenue in quarter 1 of FY23. Out of this, nearly 40% of revenue was attributable to the warehousing services, and remaining was attributable to transportation. But I want to point out that nearly 90-95% of revenue in this segment is a combined contract of warehousing and transportation. It's not a separate service contract. They are integrated contracts. Sahil pointed out that we intend to add about 1.7 million square feet this fiscal year based on our pipeline. Out of this, we have added about 500,000 square feet of space in quarter 1 based on the contracts that we have converted and expansion with the existing customers. And the remaining capacity will be added as and when we get very close to the finalization of the contract with the customers.
Thank you. The next question is from the line of Lokesh Garg from Credit Suisse. Please go ahead.
Hi, sir. Just wanted to have your perspective on competitive scenario that you face in the industry. Obviously, there are express parcel companies which are competing, which you know, but there are traditional courier companies also which we felt have not pivoted to the e-commerce business. Over a period of time, is it possible that they, combined with marketplace, shipment marketplace type companies, can actually sort of combine together, can pivot to provide e-commerce parcel services as you do, and thus could rise up the ladder and be more competitive with you? And is that already happening, and your perspective around that?
Yeah, so our perspective on this is pretty simple, which is that shipment marketplaces have a limited strategic value to the market as a whole. Any player who is a significant shipper is better served by having direct relationships with logistics companies, however many they choose to have, because their shipment volumes are large enough to ensure both appropriate price discovery as well as appropriate service discovery. And they don't really need the services of an intermediary. This isn't something that is specific to India, by the way. This is something that is seen across the world. Whether you look at the US, where customers continue to have direct relationships with the likes of FedEx or UPS or the United States Postal Services, or in China or elsewhere. The other piece is, I don't think that the reason why traditional courier companies have been unable to penetrate the market is the absence of shipment marketplaces. I think the reality is that they have not been able to address this market because the underlying models that they have are not robust enough to service the needs of e-commerce. Whether it is picking up from a widely distributed set of, merchants of variety of different sizes, whether it is investing in infrastructure to go out and build automated sortation centers or running line haul, these are not sort of physical capabilities that are dependent on shipment marketplaces in any way. So if the question is, can sort of traditional players work with aggregators and gain market share, I'd say that opportunity is probably extremely limited, because that's an opportunity that has presented itself to traditional courier companies from before the time that Delhivery began as a company. And they failed to capitalize on it, and the existence of a marketplace doesn't make it more viable.
Sure, thanks. I had the second question, which is related to the three new businesses or segments or services that you have started. One is basically same-day delivery, other is C2C, and third is economy PTL. Now, what is the relevant size that we have, either in terms of total parcel opportunity or percentage growth opportunity, that you can highlight to us from some of these services? And in economy PTL, I have an additional question as to economy PTL, essentially the slower PTL service. Today, delivery network runs all express, right? It's a single speed network. By introducing a slow service, do you end up confusing the network?
Yeah, that's a very good question. And let me answer the latter question quickly on economy PTL. The way to think about how delivery is constructed and why we run an integrated network is, think of it as essentially building a pipe and then figuring out the optimal combination of loads that need to go through that pipe. And so in some senses for us, it's a question of being able to identify what is the appropriate truck on which to place a part truckload shipment that belongs to the economy PTL segment. So we actually see the economy PTL as a way for us to take up utilization of the express network. So to give you an example, let's say we have a truck which is ready to depart from Delhi to Bombay, which is 80% full. If we happen to have economy PTL loads which are available and can ride on that truck, then they essentially get to ride for free. As long as economy PTL is not set up as a completely standalone capability, but is set up subservient to the integrated network, which is an express network, as you pointed out, it's actually a margin accretive business which delivers a better quality of service to those customers. The second thing is that the economy PTL business typically tends to have larger LR sizes, or larger weight per LR that is tendered to logistics companies. And so in that sense, the handling costs are significantly lower for us. And so again, it becomes margin accretive. The size of the economy PTL business is, the easiest way to think about it is it's about 2/3 to 3/4 of the overall part truckload freight market in India, because traditionally the Indian PTL market has been an economy or a slow PTL market. Increasingly, though, with an improvement in highways, with an increase in truck sizes, with the presence of players like us, the market is shifting from economy PTL towards an express PTL market. So for us, economy PTL is an interesting capability that we will offer to certain kinds of shippers. We will use it to drive up utilization of our network, especially in key geographies, but it's not really a standalone capability. In terms of consumer to consumer, at this point in time, it's hard to judge exactly how large that market is, because this is a market that, again, historically is one that has been starved of supply. There aren't too many options for consumers to really ship intercity from the comfort of their homes. They still traditionally have to walk up to a traditional retail outlet and ship, whereas now they have the ability to do that from their homes. Our volume growth has been pretty robust. In peak, I think, including both our direct consumer-to-consumer network as well as our franchise network, we've hit close to about 1.5 million orders in a month. And that continues to grow. However, I don't have an exact market size for how big it will be. It's an interesting capability for us to add and rides on our existing business and is high margin. And your last question was on the same day. That again is a capability that we've added for specific customers. We already provide same-day delivery services. So intra-city shipping is already same-day delivery. In this case, all that we have done is to open up some of our delivery centers or some of our intermediate processing centers as micro-fulfillment locations. where it is possible for certain direct-to-consumer brands to stock fast-moving inventory with us and for us to deliver within 4 to 6 hours in a tight catchment area. But again, it's a service that we already provide.
Sure. If I'm allowed, I have one more question, which is basically the total parcels that you're carrying obviously bulk of them originate from obviously e-commerce platform, the two large ones and some of the new upcoming ones, such as social commerce and all that. I wanted to just check with you if you have this number. Are there a meaningful number of parcels now originating from omni-channel merchants? Meaning these merchants are not traditionally online but are now becoming online because the need of the hour, and you are enabling them to do so. You took one example in the last quarter call, probably Tupperware. So are there a significant proportion of parcels originating from these? And the question is important because these are not affected by e-commerce funding situation. These are sort of running on its own steam, as you said, online buying scheme.
Yeah, I'm going to let Sandeep answer this question. Any questions?
Sure. Thanks for that question, Lokesh. When we bucket D2C and SME segment together, that actually includes mostly companies that are not necessarily just e-commerce, but also traditional brands that are now starting to actually go online. So again, most likely to be unaffected by any funding issues. Plus people who actually are asking us to pick up from store rather than pick up from warehouse. Now, I cannot tell you exactly what is the volume of shipments that we pick up from store versus pick up from warehouse. But is there an increasing salience of shipments coming from non-traditional e-commerce? Absolutely. I know it's an odd thing to say non-traditional e-commerce, but that is definitely growing. And even on e-commerce, bulk of our shipments do not come from the two large platforms. We don't actually have that degree of concentration in our business because we work across all the large platforms, including some of the vertical players who are actually quite scaled up as well and quite well funded. So yes, but to your base question, absolutely, D2C and SME and omni-channel is clearly becoming a greater salience on the overall business.
Sure. Thanks. I'll get back to the queue.
Thank you. Next question is from the line of Vijit Jain from Citi. Please go ahead.
Thank you. Can you hear me?
Yes.
Yeah, thanks. So I have two questions on the e-commerce business. One, in the same-day delivery offering, is there a pricing differential or significant pricing differential per parcel that exists between that and conventional offering? And the second question related to the price hike that you took with the aggregators earlier this quarter. I'm just wondering, to address the aggregators, do you need to do more than that over the next year? Does it include, ramping up sales presence to onboard the long tail, or do you need to build or offer channel integrations? Just your thoughts on how you're addressing aggregators.
Sure. On same-day delivery pricing, yes, same-day delivery is charged at a premium to regular delivery. And especially same-day delivery originating out of micro-fulfillment centers is charged at a premium to regular delivery. The premium varies depending on the volume and depending on the specific city in which we are operating because, costs for this are different across, for instance, metros versus non-metro cities. And we have 15 cities that we are currently operational in. To your second question, I'll go back to my earlier answer, which is that we don't particularly see anything that we have to do differently for clients above a certain size. Customers above a certain size are better served working directly with not just delivery but other logistics companies as well. And typically, the systems that they have will be capable of allowing them to manage more than one logistics partner. It also is more effective because logistics partners, whether delivery or others, have the ability to provide greater customization of services, when working directly with these customers. So we don't think that we have to add any capabilities. Those are capabilities that logistics companies have. As far as the aggregators go, they're a good sales channel, not just for us, but for all other logistics companies in the market for merchants who are below a certain size. But after merchants cross a certain size threshold, delivery and other logistics companies across the country typically will see customers approaching us directly and to integrate directly.
Got it. Thanks. And my second question is just that comment about the impact of Shopee in 1Q. I think you mentioned 22 million parcels and about a 60 crore impact on service EBITDA. Did I understand that right? So it basically translates to 27 rupees per parcel of service EBITDA impact from Shopee?
The overall impact that you saw on that slide of 60 crores also includes some impact due to revenue loss in the part truckload business at constant service EBITDA margin. But broadly for Shopee, I think the numbers will be closer to about 40 to 50 crores in terms of revenue-led reduction.
Got it. Thanks. And one final question. Could you, just a housekeeping question from my side, could you give a number for the CapEx for the quarter and the FCF for the quarter?
Amit, can you take that, please?
Yeah. So the total use of cash in this quarter was about 215 crore rupees. Out of this, about 75 crore was attributable to cash flow from operations. About 225 crore was capex, and there was about, excluding the IPO proceeds, there was about net drawdown and some receipt of money from particular investor was about related to tax indemnity was about 85 crore rupees. So adjusting all these things, the total use of cash in the quarter was about 215 crore rupees.
Thanks, Amit. Those are my questions. I'll jump back into the queue. Thank you.
Thank you. Next question is from Ankit Jain from Mira Asset from Webcast. Hi team, couple of questions. Any sense on possible loss of revenue in PTL business for the quarter due to integration? 2. Reason behind yield per parcel further coming off in express parcel business to around 69 versus 72 in FY22. Any impact on service EBITDA and core express business as a result of the same? And 3rd, nature of one-time provision cost of 40 CR.
Sure. Ankit, just on the first question, when you're talking about possible loss of revenue, do you mean permanent loss of revenue or only in the quarter? Okay. So
let's assume it's for the quarter.
Yeah. So for the quarter, if you look at our overall, if I can direct you to the slide, Apart, if you can go to slide number 3, which has the PTL revenues quarter 4 versus quarter 1. Yeah. So if you look at the graph at the bottom right, what you will see is that part truckload freight revenues have dropped from 482 crores in quarter 4 financial 22 to 260 crores in quarter 1 financial 23. So the net impact has been close to about 223 crores between quarter 4 and quarter 1. A bulk of this was related to the integration-related issues earlier in the quarter, and we're seeing volume recovery and we're seeing revenue recovery, and expect this to continue through this quarter and forward. The second question, in terms of yield per parcel, the yield per parcel is driven by a mix of clients, is driven by a mix of distances that packages are traveling. And so as that shifts, the yield naturally shifts across quarters. For example, we are likely to see an increase in yield again in quarter 3 during the Diwali period, but that's just a natural cyclicality in the business. In terms of impact on service EBITDA and the core express business, again, if I can direct you to the table that we had put up on the adjusted Ebitda bridge, Apart, if you can go to that. No, the one which goes from 81 crores to negative 217. Yeah. So our express and our part truckload businesses that mentioned share the same resources, whether it is infrastructure, whether it's staffing, or whether it's fleet. So our mid-mile facilities, for example, or our trucks are running a combination of express as well as PTL. And so a decline in the PTL volumes that are flowing through the network will have a natural impact on overall transportation EBITDA, and therefore, if you were to do an allocation, would also affect express service EBITDA in that period. So the impact from the core express business has come from the integration rather than a change in yield. The express business is designed so that the margins are constant irrespective of a change in mix of the network. So had our PTL volumes remained at their quarter four levels, even with a decline in the express yield because of a change in mix, the margins would have remained constant or would have grown with time. In terms of the nature of one-time provisions of 40 crores, these are largely claims which are related to specific outcomes. One is through this period, there were excess damages that were created in our network as the delivery and the spot-on network were combined. And the second was extraordinary package losses or package delays owing to integration issues coming out of Taudu and Bhiwandi, where we've essentially provided these as discounts back to our customers, which are a one-time integration expense.
Thank you. The next question is from the line of Saurabh Duggar from Motilal Oswal. Please go ahead.
Good evening, sir, and congratulations on integration of SpotOn. So my questions have been answered previously. Just wanted to clarify, like on a Q1Q and a YOY basis, if we remove the SpotOn integration, what would be the Ebitda and margin? And second question would be, what would be the contribution of SpotOn on the overall FY23 revenues and FY24 revenue and margin? Thank you.
Sure. Again, if I can just direct you to the Apar, if you can go back to the bridge from 81 crores to minus 217. Yeah. So broadly to your question, if you remove the integration impact on this slide, the costs that disappear are the 150 crore cost, which is underutilization of existing capacity. Obviously, the 46 crores, which are the one-time integration costs, and a portion of the revenue-led reduction in service Ebitda, which we expect will be likely in the range of about 20 to 25 crores. So 150 plus 46 is 196 plus about 25. So essentially, we would have been at an adjusted Ebitda break-even had we shown zero growth between quarter four and quarter one. So if our quarter one volumes in PTL had remained exactly the same as quarter four, and we take into account the disappearance of Shopee with overall express parcel volumes being at 150 million, we should have been at broadly a break-even in quarter one financial 23. So the costs that would have persisted, the other way to think about it is that the costs which would have persisted would have been the 21 crore capacity addition during quarter one, the inflation impact of 17 crores, and a part of the revenue-led reduction in service Ebitda to the extent of Shopee's disappearance, which would have been close to about 40-45 crores. To your second question, in terms of how much does SpotOn form, what I can tell you is that the overall part truckload business, if you go back 2 slides apart, please. The overall part truckload business was at about a quarter of our revenues in quarter one financial 22 and quarter four financial 22, as you can see, which has declined to 15% as of quarter one financial 23 owing to the integration. And so our expectation would be that as volumes recover, first of all, it would form similar percentage of our overall revenues as it has in financial 22.
Thank you, sir.
Thank you. Next question is from the line of Shashank Savla from Somras Capital. Please go ahead.
Hi there. Thanks for the opportunity. My question was more on the breakdown of the margins between the different segments. So I know you don't provide an exact number, but given that a lot of the extra cost have been related to the part truckload business, I wanted to understand if the margin trend in the other businesses is improving over time as your business is getting bigger and bigger.
Yeah. So, Shashank, broadly the answer is yes. As you can see, and as I pointed out earlier, we run an integrated network where substantially the biggest costs that are shared between the two networks are the mid-mile costs, which are the trucking terminals and the hub, and outside of that, line haul or the trucking network itself. We don't break that down between express and part truckload. And so obviously, when there is a decline in the part truckload volumes, we decided to continue running the trucking network with the same capacities to ensure fast service recovery and to ensure Express was not affected. And so there would have been a margin impact on both Express as well as PTL. As PTL volumes have recovered, margins have also recovered across both the Express as well as the PTL service lines, and they will continue to improve as PTL volumes continue to grow.
Right. And the bottlenecks and the one-off costs which you mentioned, is there any impact in the second quarter as well from that?
In terms of the service levels have remained stable more or less since the end of Q1 of financial 23 and have remained robust. So we're not seeing any sort of bottlenecks across the network. I think there continue to be one or two smaller locations where the delivery and the spot-on networks have not been fully integrated, and because of sort of the lease terms, we continue to carry redundant facilities which will be integrated. So one location, for example, specifically would be Chennai, where both delivery and spot-on operate subscale facilities, and therefore substandard for the size of the business that we intend to run, and that integration will take a period of time. But outside of that, we don't see these bottlenecks continuing across the network.
Margin impact on margin.
Yeah, and other than that, I think your question was, do we expect the one-time expenses from Q1 to continue through the rest of the year? Yes. We expect some.
So I was just trying to understand, is there any ongoing impact in the second quarter as well from the one-offs or the issues you mentioned in the first quarter?
I think a large percentage of the claims have been settled with customers in Q1. Some of them will be settled in Q2. And post that, we don't expect there to be significant sort of persistence of the one-time integration costs. Those will not continue. As volumes recover,
I want to point out that the provisions for them have been made in the Q1 itself.
Yeah.
Right. Okay. And finally, is there any guidance which you are willing to provide in terms of, or any targets for what your revenue growth or profit Ebitda margin targets would be for this year or next year?
I think it's still too early for us to provide annual guidance at this point. It's important for us to see how the next quarter plays out as well. And then obviously we're entering the peak season, so we'll have a much better sense of how the year will play out. In terms of what the economics of the business will generally look like, I think you can look at our Q3 and our Q4 results and our financials for the previous financial year. In that sense, our business is not very difficult to model. We've retained the same capacity, and as volumes go up, that's what our margin trend should look like.
Right. Okay. Thanks a lot.
Thank you. Next question is from the line of Alok Deshpande from Edelweiss Securities. Please go ahead.
Hi. A couple of questions from my side. First, I know that you've quantified the Shopee impact, but generally speaking, over the last 2 or 3 years, what is the typical trend of shipment volumes from Q4 to Q1? So like you mentioned, if you adjust for the Shopee volumes, it could have been the similar number of 150 million shipments. But historically, how does this trend move from Q4 to Q1? That's question number 1.
Broadly flat, Alok.
Okay. Understood.
In line with what we've seen, where the 150 million odd that we did excluding Shopee for Q4 has remained flat in Q1. What is different this time, I should point out though, is that the industry has degrown between Q4 and Q1 because of Shopee.
Right. And even historically, would this flat volumes be more because of delivery getting more market share? Because from an industry perspective, I would think that Q1 would be lower than Q4. Is that a fair assumption?
No, there's no reason to assume that, because Q1 actually tends to be fairly non-consequential quarter in general, right? Because there's no sales, there's no festive reasons. April, May, June is actually quite drab in India in all sense, right? Because if you have your year-end sales that happens in March, your next round of sales starts with end of season sales for fashion, which is in July, followed by Republic Day. Even your Prime Day happens in July. And Flipkart Founders Day happens in Q2. April, May, June tends to be very, very soft. There's school holidays in India. there's not much going on in April, May, June. So there's not really that much activity in April, May, June. So it tends to be more or less flat there. Last couple of years are not a good example, simply because both 2 years ago would have been impacted by COVID. But in general, it's flat or slightly below Q4.
Sure. Got it. Understood. And the second question is on, there is a statement in your filing which says that some part of this, impact on margins and volumes will continue in the next quarter also, that is quarter two. Now, are we looking at a very small part of this integration process carrying on in Q2, or are we looking at an impact which is sort of similar to Q1?
I think we've seen recovery of volumes in Q2 overall as two things have happened. One is that as claims were settled with customers, more customers have started trading. B, I think as service levels have stabilized and as our confidence in the automated facilities increased towards the end of quarter one, we also have started admitting larger volumes into the network. And so volume recovery has continued through July and into August so far. That said, like I said, it's still early. The volume recovery is continuing. We're satisfied with where we're at. It's still a little early to predict exactly what will happen in Q2 because we will have to see how volumes grow in August and sort of the later part of September when we're approaching the festive season. It's also a quarter end in September, so we'll see what the impact of that will be. So there will be some impact which will continue from underutilization, but we expect Q2 to be better than Q1, yes.
Okay. Any sense, Sahil, on whether we are guiding on FY23 overall? No numbers or no margin number, but are you confident of having a adjusted Ebitda positive FY23? Any sense on that?
It's too early to say right now. We have to look at how the rest of the year will play out, and we have to see sort of how volumes play out to the rest of the year. As long as there are no further systemic shocks, I think, we should be doing fine, but it's still early.
Sure. Got it. Thanks a lot, guys.
Thank you. Next question is from the line of Abhishek from DSP Investment Managers. Please go ahead.
Yeah, hi, Sahil. Thanks for the opportunity. Sahil, just one question, just referring to the bridge that you have given and for the PTL segment, what revenues we have seen almost about a 223 crores decline on a sequential basis. A corresponding impact of that of almost about 150 crores ex of provision, and if you include 140 crores of provision, it's almost about 190 crores. Is that a high number? Because just for a corresponding revenue decline of 223 crores sequentially, seeing an Ebitda impact of almost about 150 crores ex of provision and with provision 190. Is that a high number or is there something else that we have to look at? Just your thoughts.
I think the way you have to look at our business, and we pointed this out last time as well, is that we're an extremely high incremental margin business. And therefore, when volumes drop sharply, it's not unusual to actually see that the drop in the PTL revenues is causing that extent of capacity underutilization. The other thing to point out is that the capacity underutilization cost that you're seeing of 150 crores also, as I pointed out, includes certain facilities that are redundant and some contracts on the spot-on side which we will sunset through this year. So to some extent that 150 crores is also impacted by that. As you've seen, we've already started the process of deprecating certain facilities, consolidating facilities between delivery and spot-on. We've made progress on that in Q1. That will continue through Q2, and our hope is that a bulk of that will get consummated through Q2 and the early part of Q3.
Okay. So to that extent, we should also see a very sharp recovery when these revenues come back to maybe 4Q levels and a little higher than that. That was my point that I just wanted.
Sure.
Okay. The other thing is also, obviously we have seen the increasing corporate overhead as a percentage of revenues a little higher because of the underutilization. But should this normalize to your, earlier numbers of less than 7-8% as things normalize over the course of the year? Is that a fair assumption to make?
Yes.
Okay. There is no change in that kind of the overhead absorption, is that you're confident that you'll be able to maintain those 7% kind of number going forward?
Yes, absolutely.
Great. Just the other thing in terms of, since you're also starting the, the day service, I just wanted to get an understanding. Will that also mean that at some point in time you'll also have to kind of get into own freighters or anything of that sort, just be able to provide a daily service on a basis? Any thoughts on that?
Not at all. As we discussed on the last call as well, I think we are one of the largest shippers of air freight domestically on passenger belly. I think as passenger traffic has recovered and fleet sizes are increasing, the capacity that's available to shippers like us is increasing as well, and we are a priority partner for all of the airlines in India. So we don't see the need for us to go out and invest in freighters. Certain segments of the market may remain unaddressable for us by virtue of not having freighters, but those are segments of the market that we don't feel are large enough or attractive enough for us to really be in.
Oh, great. And just one last question. In terms of, you've mentioned about some of the, customer wins, you've mentioned a couple of sectoral names. I guess those are referring to the third-party part of the business, right?
That's right. That's the supply chain services. That's correct.
Okay. And how has been the pricing and your expected yield in that? Because since now you're a much formidable player and you're also gaining in terms of revenue, how has been the yield experience as far as the new wins are concerned from the earlier one?
Are you referring to supply chain services yield?
I am referring to supply chain services in particular.
Yeah, so supply chain services yield one client versus another client are not really comparable because the kind of movements and the kind of work we do for the client might be very, very different from a client, and also the requirements from warehousing and what the requirement from warehousing actually varies a lot. The degree of primary and secondary movement varies a lot. So they're not strictly comparable, but as I think earlier question was asked and Sahil pointed to that are the other businesses actually improving in their overall margin performance? Supply chain is experiencing the same thing at an overall level. We are being able to price better, be able to get a better margin out of that business, but you can't really. It's not like a parcel where you can actually compare one parcel versus another parcel. But the quality of the contracts are definitely improving as we go and get more and more contracts.
Oh, great. Thank you so much for answering and wish you all the best. Thank you so much.
Thank you so much.
Thank you. Next question is from the line of Abhijit Mitra from ICICI Securities. Please go ahead.
Yeah, thanks for taking my question. I hope I'm audible.
Yes, sir, you are.
Yeah. So again, just go back to that, bridge between 81 crores and negative 217 crores, just to sort of check my understanding. So the negative 150 crores of underutilization of existing capacity essentially has four components, right? So you have capacity creation in search of future demand. That's typical of Q1, looking into Q2, Q3, Q4. So that would be probably recurring every Q1. Second is your redundant capacities of spot on, right? What you will sort of gradually taper down, inclusive of employees, I guess. I think employees also I can see a lowering trend. Third is normalcy of volumes in PTL. Now, this looks like a 1 month impact. You're expecting normalcy in June, but the customer volumes are slow to sort of resume. And then fourth, the impact on account of sudden drop in Shopee volumes. So these are the four impacts, right? And depending on normalization of each of those four things, you will sort of see this 150 crore play out over the rest of the year.
That's correct. The incremental capacity addition that you refer to as the first of the four is the 21 crores that we have pointed out here. That is the typical sort of normal capacity addition that will happen in Q1.
Okay.
The underutilization of existing capacity, which is the 150 crores, is, as you had pointed out, the excess capacity that was created for two reasons. One is continuing to have redundant infrastructure between delivery and spot on, and the second is that as volumes dropped sharply, we decided to continue to keep that capacity to stabilize service levels faster, and which is sort of played out because service levels have been stable since the end of Q1 and remained robust throughout. So that will normalize through this year. The third, obviously, is the inflation impact, which is again an annual cost that we take in. And the final one, which is the revenue-led reduction, is because of Shopee. That's correct.
Yeah. And just to sort of focus a bit on the KPIs, I think there's a slide where you have beautifully depicted the KPIs. So there is one item which is revenue per square feet. So here, my sense is you have taken only the warehousing revenue. Is it true? As in, is my understanding right? You have not taken the transportation part within the supply chain.
Amit, can you answer this question?
You're right. Yes, you are right. This is only
So here you are actually breaking it up into warehousing and transportation, right?
So the transportation revenue per square feet corresponds to the revenue divided by the square feet of transportation infrastructure we operate, and warehousing revenue attributes to the warehousing revenue divided by the warehousing square feet we have.
So warehousing component within the supply chain business.
Yes.
Got it. That's all from my side. Thanks.
Thank you. Next question is from Aditya Mongia from Kotak Securities from Webcast. Given the majority market share in express parcel that Delhivery has, what is the end game for Delhivery's market share within 3PL players over the next few years? And what 3PL market share does it make sense for Delhivery start growing pricing? Any sense of timelines for the same to start reflecting in the financials? What is your stance on prospects of utilizing your PTL infrastructure capacity towards growing slow PTL business? Would that not be return or margin dilutive versus deploying such capacity to grow express PTL business faster?
So, Aditya, hi, Sandeep. Thank you for the question. Let me answer the first question and then maybe we can come back and talk about the PTL portion. On express parcel, we are the largest player in the market. We've the largest market share and we've been gaining share in the market. I think it's hard to say what the logical endpoint is of market share in this, for us, because while customers need a redundant partner, it's not clear whether they need 3 partners and 4 partners, and whether at some point we thought customers will have 20% shares or 25% shares to each partner, but we are breaking that, and we have customers who actually give us 70, 80, 90% share of volume, and we have customers who give us 35, 40% share of volume. So I think our objective is going to be to continue driving down cost and improving service level, and then tactically pricing into the market to see how much of that we want to gain from a share perspective, and how much of that we want to invest towards how much do we want to keep as margin, and we'll continue doing that over the next few years. And I don't think we have in mind a logical point that at 30% share we'll start pricing up, or 35% share we'll start pricing up. I think there's clear margin opportunity for us to gain share, and we'll continue to gain share. We clearly see opportunity to further rationalize cost and bring efficiency into the system. And as long as we see that, there's no reason for us to keep not gain share. At what point do we start pricing up? I don't know whether it's the question of whether we need to price up parcel to actually make money or make margins. It's actually how much more efficiency can we get from the system. So there's still more we can push through the pipe efficiently before we have to start actually pricing up. I think the benefit of this is going to be that there's going to be a point at which our pricing ability versus competitors will actually be very, very, very differentiated. And then you'll see the real share gain for us, whether it's, and there's no limit to how high that can be. At least we are not setting a limit for ourselves. So I think that's where we have to focus on. I don't think in the short term the game is of having to increase prices. We can get margin through reducing cost and putting more through the pipe. And that's what we'll do. When we'll start reflecting in the financials, as Sahil has mentioned a couple of times today already, we are an integrated network with high incremental margins. I think both PTL, Express PTL and Express Parcel have to play in tandem for that to start reflecting effectively in our margins. Sahil, you want to talk about part truckload and how you want to think about that?
It's a good question on utilizing the PTL infrastructure capacity. I think I would just point out one thing, which is that it's not the PTL infrastructure capacity, it's the combined capacity that we've created in mid-mile operations, which is the hubs as well as the trucking network. And the way to think about how we will grow the economy PTL business, the way we think about it, is that it's not, I will repeat, double bold and underline that it is not a standalone capability that we intend to build. So the objective is not to go out and compete with, traditional economy PTL players where there is a sort of fairly fragmented and large space, and to build an independent economy PTL business. There are certain locations which our express network services, where it is possible for us to drive up utilization of the vehicles by developing an economy PTL business, because in those locations an express PTL business may not exist at all. And in some locations where, for example, the average utilization provides us enough space to go and develop specific accounts in specific verticals, which we are aware of. And sometimes the same shippers end up having a combination of express PTL and economy PTL requirements, which our intention is to serve.
Thank you. The next question is from the line of Pulkit Patni from Goldman Sachs. Please go ahead.
Thank you for taking my questions. So my first question is if we just take a step back and look at on the PTL side in Q1FY22, we did 279,000 tons. That number after spot on is now 239,000 tons. So, I mean, while I understand there's been integration issues, but how come the volumes are even below what we used to do pre-spot on? So if you could just help understand that better, because without spot on, we could have done similar numbers, if not more. That would be my first question.
The 279,000 tons, can you just open up that slide, please, Apar? Just to be clear, the 279,000 tons for Q1 of fiscal 22 will be pro forma, so that will also include spot on. The delivery standalone volumes are not 279,000 tons. So in that sense, the delivery, when you compare the delivery pure business to Q1 financial 23, the business has grown in the same period. The reason for the decline is essentially us cutting out volumes in specific locations. The two highest volume locations from which we cut out volumes were where we have the largest automated gateways to allow the network to stabilize, which were out of our gateway in Taudu and out of our gateway in Bhiwandi. And therefore also cutting out certain locations which connect into these major locations. So for example, Pune connects via Bhiwandi. And so making sure that we provide a standard service quality and cut volume. So that's why you see the cut in volumes in Q1 financial 23.
Makes sense. And a related question on realization. Once the integration of spot on is fully complete, is there a possibility we could have higher realization, given that some of this also is realignment of clients, etc.? Or do we expect realizations to be?
So the line for the participant dropped.
I think his question was, do we expect realizations in the part truckload business to remain broadly constant? I think, again, realization in the part truckload business, and I'm answering this for the benefit of everybody else on the call, is again a mix of all of the different clients who form the part truckload business. It's a combination of a mix of our corporate, our retail, and our small and medium businesses. And as those percentages change, the realization of the part truckload business changes as well. That said, pricing in the part truckload business is something that is sort of well discovered. It's a market that has existed for a long period of time. And so to that extent, what we do is to follow market pricing. Our approach will be similar to what we did in Express, which is to be the most efficient player. And therefore, over a period of time, either have margins which are supernormal compared to other competitors in this space, or to pass on pricing benefits to customers.
Thank you. I now hand the conference over to Gaurav Deria from Morgan Stanley.
Maybe I can just chip in one question here. On the PTL volumes, where are we now versus the normalized volumes? By when we expect to get back to the 4Q levels? And a related question is that for fiscal 23, would PTL volume would remain constant, or it will kind of has still potential to grow because we have lost out some time now?
I think, Gaurav, it's still early to say. We have, as I mentioned, seen service levels be completely stable since the end of Q1 financial 23. And the operational issues at Tauru and Bhiwandi have been sort of conclusively resolved. Those have remained stable into Q2 so far. We don't anticipate any disruption coming from this. The reason I'm not yet going to provide a forecast on what our volumes will be for the year or what our recovery will be is that one of the hypotheses we had is that as the delivery and spot-on network combined and as we discovered efficiency by combining the two networks and additional capacity, we might be able to grow faster than we had originally planned as well. But at this point in time, let me put it this way, the operational issues are behind us. We've settled claims with our key customers in Q1. Whatever few claims were left will be settled through Q2. We are seeing volume recovery through Q2 and we're quite satisfied with where we're at. And we'll see sort of at the end of this quarter how the rest of the financial year will play out.
All right. Second question was on the synergy benefit on integration and upgradation of the network on trailers. When does that really start to flow into the margins? And any quantification of integration-related benefit that we can see?
Sure. As I pointed out in our previous earnings call also, Gaurav, our aim was by the end of this financial year to first of all take the combined PTL business post-integration to the pre-integration margins that Spot-on had. So that continues to remain our target. There's no change in that target, the integration issues of Q1 notwithstanding. And then to start discovering synergies, because I think that's the period that it will take for us to eliminate all redundant infrastructure to ensure that there's complete consolidation of facilities and teams. So that process is underway. That continues to remain our target, which is to get the business to pre-integration spot-on standalone margins in this financial year, and then to start discovering synergies. In terms of tractor trailers, we continue to induct tractor trailers across our network. As you've seen, we've inducted close to about 30 tractors and 85 trailers in Q1. We will continue to do that, and as volumes are going up, those tractor trailers are replacing relatively less efficient 32-foot single axle and 32-foot multi-axle vehicles. And so that movement will continue through the year. And the difference in costing, for example, in line haul between the tractor trailer operations and the 32-foot single and multi-axle trucks can be as high as 25%. So we expect to continue to see those efficiencies as tractor trailers come in.
All right. Those are all the questions I had. So on behalf of Morgan Stanley, I thank the management team of Delhivery for the detailed insights and their time. Thanks everyone else for joining the call. Over to you, Nirav.
Thank you very much. On behalf of Morgan Stanley, that concludes this conference. Thank you for joining us. You may now disconnect your lines.
Thank you all. Thank you for joining. Thank you.